Hi, my name is Asadur and today I will be presenting for FIN500 Financial and Accounting Skill for Managers under the guidance of Professor Nima Salame. The presentation takes a real-world entertainment example, Taylor Swift journey through the music industry and applies core accounting principle to analyze three keys financial transactions. My goal is to show how GAAP standard govern even the most glamorous concern of the business world. Case study overview. The case sentence of three parties. Taylor Swift is the recording artist, one of the most commercially successful musicians in the history, who famously fought for ownership of her master recording. Big Machine Records was her original label from 2006 to 2018, responsible for funding, processing, and distributing her albums while controlling the master rights. Spotify represents the digital streaming platform side of the equation, paying royalties on a per stream basis to rights holders. Together, these three parties generate a web of financial transactions that are rich with accounting implications. Uh, Slide 3 is transactions 1, artist advance payment. The first transaction is an artist advance. Big Machine Records paid Taylor Swift $1 million upfront upon signing her record deal. In the label books, this is recorded by debiting artists' advances and asset accounts for $1 million and crediting cash for the same amount. The account equation remains balanced. One asset increases while another decreases, leaving liabilities and equity untouched. The critical insight here is that this advance is not income, it is a recoverable loan. The label will recover this amount from future royalty earnings before the artist sees a single dollar in royalty payments. Uh, Album production cost, streaming royalty revenue, transactions 2. The second transactions involve streaming royalty revenue. Spotify pays Big Machine Records $500,000 for Taylor Swift catalog stream in the fourth quarter. The label debits cash or accounts receivable and credit royalty revenue for $500,000. This time equity increase because revenue flows into retaining earning under ASC 606. The revenue is only recognized at the moment the streaming service has been delivered. The performance obligations is complete. Morrow and Gardin note in their 2024 study that per stream payment model raise serious fairness concern as the revenue artists ultimately receive after label recoupment can be a fraction of the gross amount. Transaction summary. Advance streaming and production, and type is asset, advance asset, streaming asset, and revenue, production asset, liability plus cash. Accuracy analysis and correction. Common misprotalias in music industry accounting. Advance details as income, pre-stream revenue, overstated production cost, fully expense. So Stepping back to look at all three transactions together, we can see a clear pattern. The advance moved $1 million between assets accounts. The streaming revenue brought in $500,000 and increased equity. The production spent capitalized $2 million in intangible assets. In total, $3.5 million in assets were tracked across these entries. $500,000 in revenue was recognized and equity grew by same amount through royalty income. Every entry balance and the accounting equation holds throughout.